This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 258 was recorded on February 11th, 2021, as MacroVoices turns 5 years old this week. I'm Erik Townsend. This episode is brought to you by Abaxx Technologies, pioneering the design of smarter markets that better meet the needs of both market participants and society as a whole, and by Diamond Standard, the world's first regulator-approved diamond commodity. A $1 trillion natural resource is finally liquid. Visit diamondstandard.co. With so many top macro analysts switching to a secular inflation outlook, I wanted to bring back some of our strongest macro stars. Julian Brigden returns as this week's feature interview guest. We'll discuss why Julian thinks equity valuations are already stretched, but you guessed it, he also shares the inflationary view expressed recently by Russell Napier and Jim Bianco in recent episodes. Then be sure to stay tuned for our Postgame segment when Patrick's Postgame chart book is titled Rolling Bubbles. We'll look at what's going on with, it seems like, a bubble in everything.
And I'm Patrick Ceresna. Now, Erik, let's jump to the S&P 500. Pretty much 5 days of the S&P 500 slowly crawling higher. We're pivoting right on the 3,900 level at the time of recording. Anything change in your outlook on the S&P from last week?
No real change in my outlook. Medium to long term, I think it's higher, and it's based on secular inflation. Now, frankly, if a 1987-sized crash started tomorrow, I would just say, oh, well, that was years overdue. So I don't think there's any reason that the market couldn't crash, certainly as a lot of very smart people, Stan Druckenmiller, lots and lots of smart guys are saying, hey, this is crazy. We're at nosebleed high levels here. Valuations are stretched, margin interest, all these signs are there. It's got to be a top. Those are some incredibly experienced and intelligent people, whether it's a Stan Druckenmiller or a Jeremy Grantham or what have you. But frankly, Stan Druckenmiller said the same thing, 500 or so S&P points lower, and it wasn't right then. And I think we've got a crack-up boom in play, and it could take us much, much higher. Frankly, I'm glad to be a crude oil trader. I don't have any exposure in either direction to equities, and I frankly don't really want any.
All right, well, let's move on to the U.S. dollar index because looked like we had a breakout last week, and this entire week it's just been giving it all back. We're still above the 90 handle, but certainly no follow-through on last week's strength. What's your take on all of it?
Well, maybe it looked to you like we had a breakout last week. When you said that on last week's show, I said, I don't think so. Wait till you get at least a close over 92. And I thought we'd at least get a test of 92. We didn't even get that. We fell well short of it. And at this point, we've broken down through the upward sloping trend line that was forming since that bottom at the key support level of 89 or so. And, my guess is that we're in a consolidation that ultimately is going to resolve lower, maybe much lower if that key support level breaks. Now, to be sure, if you saw a daily close over 92, which was the previous support level, that would suggest that there is a real recovery in play. I'm not expecting it at this point, but remember, this whole discussion about the dollar index is relative to other currencies, and that means it's politics, not economics. Don't underestimate Christine Lagarde's ability to print just as recklessly as Jerome and Janet in the United States. I think the clear call here, which is just resoundingly clear in my mind, is all fiat currencies devalue in purchasing power in coming years. The dollar index is relative, and, frankly, that's a much harder call to make than the absolute call that all fiat currency loses purchasing power. The play there is gold or Bitcoin if that's your thing.
All right, well, let's move on to the one market that continues to trend quite strong, and that's crude oil. Doesn't seem to quit. It almost seems like 60 is a foregone conclusion here. What's your take on crude oil, and how did the inventory numbers come in?
Well, inventory came in with another big drawdown, 6.6 million barrel drawdown on crude oil inventories, offset to some extent by a large gasoline build of 4.3 million barrels, but distillates drew down 1.7 million barrels. U.S. production ticked back up to 11 million barrels. That's up 100,000 barrels from last week. So, I think you said 60. Frankly, I think 60 spot 92, 6092. Is the logical target for this rally. That's a pretty significant technical level. And at that point, I would expect, I guess I'll have to say, another consolidation. I want to say, based on the way the markets normally work, at that point, surely we ought to get some kind of significant retracement and an actual technical correction in what has been really just an unrelenting rally. I've gotten to the point where I'm no longer expecting technical corrections to occur. We just get these sideways consolidations that last for a while, and then it powers higher. And I think there's plenty of good reason to expect the market to move considerably higher than that 60 spot 92, call it 61 approximate number, because frankly, everything that's happening so far is happening with U.S. production staying steady. We haven't seen any sign of Art Berman's prediction coming true that eventually, before this year is out, we're going to see a significant decline in U.S. production. If and when Art is proven right on that, of course, I don't know if he will be, but if he is, that's just fuel to really accelerate the rally even further to the upside. If you look at what's happened here, Art said $65 by the end of the year, and everybody thought that was just, too optimistic, too aggressive. That was 6 weeks ago in the beginning of January, first episode that we did this year. Now we're almost there, and it's only February. It's only 6 weeks later. I said 75 this year, and frankly, at this point, I won't be surprised if it's much higher before the year is out. But the easy part is behind us. It was easy to see that we were going to get a recovery in oil prices back to at least where we were before the coronavirus crisis began. That's already happened. Now the question is, will we see that phenomenon of demand coming back just at the time as a lack of investment has caused supply to fall off to the point where it causes that squeeze that maybe pushes prices much higher, maybe north of $100? I don't know. That's not so easy to call. That's a possibility, but it only happens if a bunch of dominoes fall exactly the right way. So the easy part of this is behind us, but I do think we'll head higher before the year is out.
All right, well, let's circle to gold because gold was just trading below its 200-day moving average last week when we were recording and really didn't seem to accelerate on that breakdown. And we got back toward 1850, but really back just into the trading range pocket, no real uptrend or anything. Do you think that was just a fake out on the downside, or you think there's still room for more breakdowns in gold?
Well, actually, I think there is more downside potential. And the thing is, that was a pretty darn hearty bounce that we just saw. But frankly, it's off a descending trend line. And I think that there is a new downsloping channel that's formed. That channel resistance is now 1837. And what do we see? A super exuberant bounce. Where did it get to? Just about 1837, which was tested and rejected. And now we're trading lower. So the next test will be to see if we can get back down to channel support, which right now is 1765, and of course it's a downsloping line, so it gets lower every day. That's co-located approximately, though, with the November low. So I think what's most likely coming next is a test of that November low around 1765. And, is it a double bottom there, or is it just the beginning of a move even lower? We'll see what is in the cards. But frankly, nominal yields backing up means increasing real yields, which is gold's enemy. Now, I'm convinced that those increasing real yields are leading, and what's lagging but hasn't been recorded yet is inflation, which is going to offset them, and we're actually going to realize that we have negative real yields, not increasing positive real yields. But right now, the instrumentation is telling us that real yields are positive and increasing, and that's gold's enemy. Therefore, I think that this correction is a gift. What you want to do is buy the bottom of this correction and buy it in size. rise. Now, that's an easy call to make. The harder call is, okay, so how do you call exactly where the bottom is? How do you know where that number is? Is it 1765 or is it 1500? I really have no idea, Patrick. I do want to touch on Bitcoin, though, this week. And the reason is I think that Elon Musk's sudden, very public involvement in the crypto market, in Bitcoin particularly, could be the catalyst for the next great big move higher. So although Bitcoin is not my favorite asset, for those of you guys who just want to have a reason to think it's going to 100,000 or 250,000 or whatever your favorite number is, a million, if anybody can get it there, it's Elon. Think about this. Elon Musk is the man who literally became the world's richest man. He has now outpaced Jeff Bezos. He is the richest man in the world, despite the fact that he has never once in his life run any business profitably. This guy is the most accomplished con artist in the history of humanity. And the fact that he's been able to promote Tesla, a company which has never had a viable business plan to justify anything close to its market capitalization, so successfully, really stands as testament to his ability to sell a story, and a story that's not really backed by hard economic fundamentals. Now, in the case of Bitcoin, you have an asset. I know many of our listeners really feel like Bitcoin is the future, and certainly I think digital currency is the future. I'm not so convinced that Bitcoin is the future, but hey, if you get a promoter like Elon behind it, if there's anything that can take a story like Bitcoin, where a lot of people think it is the future of the world, what you've got to do is get a promoter behind it who has been successful at persuading the world that his car company that's never shown a profit is worth more than collectively all of the other car companies combined, the ones that are profitable. And that's something that Elon has an incredible ability at doing. So I think that this involvement of Elon Musk, and the big news that came out this week was that Tesla has bought a very large stake of $1 billion or more in Bitcoin. Wouldn't it be ironic, Patrick, if the way that Tesla finally actually shows a profit, because clearly there's never been a viable business plan for building electric cars to show a profit, what if he shows a profit in Tesla by trading Bitcoin, and that's the way Tesla becomes a profitable company? If anybody can spin that story and make it happen in the marketplace, it's Elon. So as much as I do think that this is a speculative mania that's driven by human stupidity as opposed to economic fundamentals, frankly, there is no shortage, as Einstein told us, of human stupidity. And there's nobody who knows how to work that human stupidity and play it to his own advantage better than Elon Musk, who suddenly is a major investor in Bitcoin and a big proponent of Bitcoin. So I think that the sky could be the limit in how far this rally goes. Now, please don't call me a Bitcoin bull. I remember Jeff Snyder's comment when I called him a dollar bull. He says, look, I think the dollar is broken. It just happens to be broken in a way that it's going to go higher, not lower. I don't think that the Bitcoin rally is based on any logical, fundamental reason other than a whole lot of people don't really understand what this is and what the future is. But I do think Elon has the ability to take it far higher than it is now, potentially several times higher than its current, almost $50,000 last I checked. If we get to $100,000 or $150,000 on Bitcoin and Elon takes us there, I won't be the slightest bit surprised. At the end of the day, the intrinsic value of Bitcoin hasn't changed, 0.00.
All right, so let's move on to the 10-year Treasury yield, because that has also not let up. It continues to gravitate just under the 1.20 yield, and it really looks like it wants to go. Do you think we could see higher yields here in the immediate future?
Patrick, I've been thinking about this a lot this week because on one hand, clearly, the federal government cannot let Treasury yields run away. They can't go much higher, like normal kind of higher, 5, 6, 7, 8%. But, they can go back to 3%, which seems like forever from here. We've gone just from 50 basis points to 1%, and everybody's acting as if it's the end of the world. We certainly could go from 1.2%, wherever we are, 118 basis points, I think it is, last I checked, to 250 to 350 basis points. That's an entirely believable move before intervention is required. I think it's just a question of whether or not Team Janet and Jerome are going to let it go that far. And I don't think we really know that. But boy, look at the front end of the curve. Whether you want to see that as the 2s, 10s accelerating or the 3-month, 5-year curve really accelerating, look at 6-month Treasury bills yielding 4 basis points. Holy cow. So I think it's going to be really interesting to watch what the front end of the curve does, and particularly remember Charlie McElligot's warning of fear the steepener. Well, don't know what Charlie's saying these days. We should get him back on the show to talk about whether the fear should be there. But I'll tell you one thing, the steepener is definitely with us.
Well, this week's feature interview guest is Julian Brigden. So, Erik, why did we invite Julian back on the show this week?
Well, Julian is without a doubt one of the smartest macro guys that we know anywhere. Absolutely brilliant analyst. Why right now? Well, because I want to get the smartest macro minds that we know to weigh in on this question of whether we're seeing a return to secular inflation. And sure enough, although Julian thinks that the stock market is overcooked at current levels, longer term, he's very much on board with the inflation view that you've heard from Russell Napier and Jim Bianco and other guests in recent weeks. So this was a really interesting interview. I think you're going to love it.
Well, Erik's interview with Julian Brigden is coming up as MacroVoices continues, right after this message from our sponsor.
This episode of MacroVoices was made possible by Abex Technologies, which also sponsors my new Smarter Markets podcast, which airs every Saturday morning and explores how the markets themselves could be redesigned to better serve market participants and society as a whole. My interview with Dr. Ben Hunt is available now at smartermarketspod.com and focuses on narratives in social media influencing financial markets and society as a whole. My guest on Smarter Markets this coming Saturday morning will be Peter Fusaro, longtime sustainable investing proponent and founder of the Wall Street Green Summit. But you won't get Smarter Markets on your MacroVoices feed. You have to separately subscribe to Smarter Markets in your podcast app to receive this free new podcast.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me now is Julian Brigden, founder of MI2 Partners. Julian is known for his graphs and charts, so you're not going to want to miss the chart deck, which Julian prepared for today's interview. Registered users will find the download link in your Research Roundup email. If you don't have a Research Roundup email, that means you're not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, look for the red button that says Looking for the Downloads. Julian, I want to say not quite a year ago, but last spring, as markets were bottoming, you turned super bullish, and everybody said, Julian, you're crazy. There's a global pandemic on. What are you smoking in Colorado, dude? And sure enough, it seems that you've been right. I don't know that you perfectly nailed the timing of the bottom, but it was pretty darn close. And it has, of course, been straight up ever since in the market, very consistent with your expectations. But my big question to you, as we start to dive into the slide deck here, is, okay, that was in the spring, but now that we're back to all-time highs, new all-time highs, are you still bullish?
Thanks, Erik. I mean, yeah, it's been a good run. I think, in fairness, if I take a step back, I structurally want to remain pretty bullish. I do think in certain trades, we're in the second innings of some of these trades. I mean, I look at things like commodities, and I think we're in for multi-year trends in some of these areas. But to your point, it's been a good year. And, you know, when we look at the models and the slides and our leading indicators, some of them are just at sort of levels where I think one needs to be a little bit more nuanced here. So, for example, if you look at the first slide that I put in the deck, it's just a model of ISM manufacturing and the ISM manufacturing series. And I mean, it's had a stupendous rebound, right? I mean, this is what we played in 2009, in the summer of 09. People were once again getting very bearish. We'd come off the lows of the spring after the GFC, and people were saying, oh my God, the underlying economy is really damaged. We've got huge problems. And yet these PMI models just exploded to the top side, and it got me very, very bullish. And we were looking at the same thing again this time, and markets love these soft, fast-moving metrics. They use them as a leading indicator. But at the end of the day, these things are really month-on-month rate of change metrics. They don't really measure the absolute level of economic activity. They really just measure the rate of change. So the minute that you stop falling, these things actually start to rebound very strongly. But as we stand here, having played this sort of rebound, the reality of the situation, Erik, is it doesn't get any better than this. I mean, this is as high as these things ever get. It doesn't mean they're going to collapse. I mean, I think there is a reasonable chance that we can bump along the ceiling as we did under Trump's first few years when he was pushing the fiscal stimulus. But even if we don't, we're going to settle down into a sort of the low 50s, which is 2.5% GDP growth. So it's just that kind of initial oomph has dissipated a little bit. And then you look at, say, the second chart. And I think this is where the rubber meets the road a little bit. This is just a chart where you look at the rate of change in consumer confidence over GDP, and you can see there's a bit of a problem here. The consumer really, and it's an awful lot to do with the next slide that we'll talk about, but the consumer doesn't really appear quite as rosy and as healthy as the current market narrative would suggest. And one has to ask oneself in this situation, is the level of spending that we're seeing in the economy just being propped up by additional fiscal stimulus? And I think that is a real issue. I mean, we're going to get it. It doesn't mean it's a negative, but once again, when you sort of look under the hood, things are not quite as sexy. And the fundamental problem actually is when you look at the next slide here. So there's good news and there's bad news in this. So when you look at total non-farm payroll in red here against the JOLTS data, job opening and losses data, you can see that it looks like we're going to rebound even further in the total non-farm payroll. And that's kind of my expectation, that we are going to probably add about another 4 to 5 million jobs. The bad news is that at least thus far, and that's certainly what we're seeing in terms of this loss of momentum in terms of the recovery of jobs, it doesn't look like we're going to go back to 130 million jobs. We're almost certainly going to end up having lost about 4 to 5 million jobs, and probably permanently. And that means that we're going to end up with an unemployment rate somewhere in 6 to 7% range. And from a policy perspective, that just means that you're going to need continuing ongoing policy support and policy help to keep this economy going. Now, the good news is that certainly seems to be coming through in spades, certainly on the fiscal side. But the bad news is when you look at the monetary side, which you can see in this next slide, slide 5. Now, there are two commonly used financial conditions index. And just for listeners, let's remind ourselves, look, the Fed controls Fed funds, but at the end of the day, that is just a vehicle to influence broader financial conditions. And when you create a financial conditions metric, it basically has 5 components. Short-term rates, you can use Fed funds or 2-year yields. Long-term yields, typically 10 years. Credit spreads, stocks, and the value of the dollar. Now, this one is the Chicago Fed, and I actually prefer this one. I think it works better for what I would call domestic financial conditions. And then there's the Goldman Sachs one, which is also quite commonly used. And I actually use that for overseas dollar financial conditions. And the reason is there's a much, much heavier dollar weighting, it would appear. They don't give you the exact metrics, but that would be what it looks like to me. And you can see here with the Chicago one that despite everything, right, despite the fact that bond yields have fallen a long way, despite the fact that stocks have rebounded, despite the fact that the dollar's been a little weak, we're actually not back even to financial conditions as they were at the start of 2020. So this is a singular problem for policymakers, that it's quite difficult. There is no more ammo unless you're willing to go negative yield at the front end to push yields down. If anything, it's highly unusual to see, and we've talked about this many times in the past, Erik. Remember I showed you charts of the Fed's balance sheet against bond yields, and whenever they typically did QE, bond yields rose, not fell, because QE is, as it says on the top of the tin, reflation, and bond yields don't fall in a reflationary environment. So this fall that we've seen post-COVID is quite unusual. So the risk is actually going forward that as they do more and more QE and the economy recovers, actually bond yields will rise, and that'll reverse some of the easing of financial conditions we've seen. The dollar's not that easy to get significantly weaker because people like the ECB and the BOJ aren't going to like it. I don't think there's much they can do to stop it ultimately, but the Fed will have to try quite hard to get us there. Stocks are already at nose-bleedingly high levels, and credit spreads, blimey, I mean, you really can't get them much tighter than they are now. I mean, I think if you take something like, triple C against B spreads, you're about as tight as you've ever got historically. So the point is this monetary pulse that we've got is really limited, which leads us to most of the heavy lifting going to have to be done on the fiscal side. Now, the good news is the Biden administration is determined to do this. I think the market is still probably underestimating the ability of the administration to push through the stimulus package. I noted yesterday Goldman Sachs came out and upgraded their timing for their first rate hike because they thought that they could get through 1.5 trillion on this round. I'm still pretty convinced, talking to my friends who follow this stuff more intricately than I do, that we're looking at probably 1.9 or much closer to the 1.9 than people realize. So they're certainly willing to spend the money. And there's another big infrastructure package coming in probably Q3, or at least to be planned for Q3. But this can come at significant cost. And I think this is where I'm beginning to get a little bit more concerned about markets. So we've had this sort of free ride up until now, where essentially we haven't had to pay any of the cost for the spending and the stimulus that we've added into the system. But we've been here before, Erik. I mean, you and I have talked over many, many years, and one of the big conversations we had was when back in the middle of 2016 we started to turn extraordinarily bearish on the bond market, and the dynamics are not vastly dissimilar. I mean, if you cast your mind back, then we had in late 2015, the Fed had raised rates, China had devalued, all the policymakers run off to Davos. They start getting very concerned about the economy rolling over again. They come out and unleash a wave of reflationary stimulus policies again. Markets take off in early 2016, and by particularly oil and commodities. And by early 2000 and so by the middle of the year, our models were kicking up really expansively on inflation. And then the bond market fell out of bed. And I look at the dynamics now and they remind me of that period. And, we should understand that this level of fiscal stimulus, and once again, we've talked about this next chart a lot over the various shows that I've done with you. And this is this sort of analogy to the late 60s. And this just amazes me, Erik. This is just a rhyme that just keeps giving and giving and giving. So if you looked at the early 60s, we'd had this halcyon period of super low stable inflation. I think the average rate was about 1.3% from sort of 59 into 65. Back then, we didn't have the level of debt, so no central banker was running around with a sort of waving their hands in the air in some sort of international sign of distress about deflation. This was really halcyon post-war economic growth period. Bonds did well, equities did well, everything was fine. Kennedy gets assassinated. Johnson sweeps both houses, just like Trump did. He's able to push through his personal agenda, which was the Great Society. It happens in an economy which is already doing extraordinarily well. The Fed miscalculates, thinks they can let things run a little bit hotter than they could. Inflation breaks out in sort of 66. They come in and they hit it hard, and inflation's jumped at that point towards 3%. They hit it hard. The equity market cracks, coincides with a downturn in the housing market, and they panic and they give all those rate hikes back, and the economy catches again much quicker than they think. And the reason was that there was ongoing fiscal stimulus. So I think, the rhyme breaks down a little bit because of the COVID news that we've in the events that we've had. But essentially, that's what's happening. We had Trump come in. He initially overstimulates the economy. The Fed hit it hard in 2018. We obviously get the equity wobble. They back off. Okay. COVID comes in the interim, but now we have a much larger ongoing fiscal stimulus package in the works, which is akin, fighting COVID is in a way similar to fighting a war like we did with Vietnam. And I don't think we should expect the outcomes to be significantly different. And it didn't take long, only 5 years, to take inflation from 1.3 to 6%. And even if you look at the Fed's own paper and their own work, they'll tell you that inflation expectations become unanchored within as short a period as 2 years. In other words, from that point onwards, people start to indulge in behavior that in itself generates the inflation because they expect higher prices. And to my mind, this is the single problem facing this sort of risk asset run up that we've had up until now. We haven't been challenged by bond markets. Just bond yields are rising a little bit, but the equity guys are saying, well, this is great. This steepening of the yield curve, this bear steepening is in itself a sign of reflation. And they're right, but bond yields have still remained highly contained, even though things like break-evens have just ripped, and we still think they continue to do so. But I'm just wondering whether we're getting to one of those points where it's going to be a little harder to control. And I think when I look at markets, valuations are so extreme that it becomes a little problematic, because what you've really done in this run up is you push some valuations to really, really high levels. So by that, I mean, if you look at a stock like Apple, right, linchpin of arguably of the US equity market. So going into COVID, Apple was trading in the mid 20s in terms of PE. It sells off into COVID, and then it rebounds. But if you look at this next chart, what you'll see is it really exploded when the Fed stopped doing QE last summer. Now, that's quite an unusual price action, because historically, when you go back and look at the price action around those pivots in the Fed balance sheet, so they're either expanding the balance sheet or they stop expanding the balance sheet, the pattern was extraordinarily clear. During bouts of balance sheet expansion, you bought equities and you sold fixed income, you sold bonds, yields rose because it's reflation. When they ended QE, you sold equities and you bought bonds because it's disinflationary. It's very simple. But this time, that didn't happen. You might have sold the broader market, but you bought a specific type of equities. You bought these so-called growth names, which we know is an oxymoron, because these are names that can grow when there is no growth. So essentially, they become replacements for treasuries. I like to refer to it using the phrase ersatz treasuries, right? They are literally replacements for treasuries. And that's great in theory. It's worked very well. But there is a singular problem here, and the singular problem is that what happens when bond yields start to rise? Okay, what happens to these mega cap tech names, which are the linchpin of the US equity market and the reason why it's outperformed all its peers across the whole world? What happens to these names if and when bond yields rise? Because it's pretty clear to me that most equity investors don't understand the degree to which they have essentially written a put by buying these names on the bond market. Okay, so if the PE in Apple has gone from 25 to 40, and at one point just before their last earnings it was mid 40s, and it's a 2% yielding stock, what happens if treasury yields go from 1 to 2, and Apple's yield, to keep it attractive and a sexy place to put your money, has to go from 2 to 3? Well, all other things being equal, Apple stock has to halve to do that. And this is the single problem. Now you've pushed prices in these markets, Erik, to a point where you're beginning to create stress across the cohesion of all these markets as they interact. So, great, we push equities higher, but in the process of pushing equities higher, now that we've got some growth coming back in the economy and some signs of, insipid reflation coming back and inflation, if you push equities higher, do bond yields go higher? And if bond yields go higher, do the leading stocks in the US equity market start to come down because they have these super high PEs predicated on low bond yields? So you've essentially stretched valuations to the point there where the interaction between markets becomes much more dynamic. And that can create room for problems, right? I mean, look at this next chart. I mean, Tesla, for example. I mean, Tesla, I've shown you numerous charts over the years of what I would refer to as a classic bubble. There's absolutely no doubt that Tesla is a classic bubble.
Now, let me interrupt you there, Julian, because, okay, I see on the chart Tesla, it sure looks like that classic bubble pattern where maybe if it hasn't topped yet, it's got to be awfully close. But wait a minute. We are in an environment where the Fed has never been before, nothing close to it. And Tesla may have a chart that looks like it's in a classic bubble, but it's also run by a world-class con man, the richest man in the world. Now think about this, Julian. The richest man in the world is a man who has never run any business profitably in his life. That is con man skill that makes P.T. Barnum look like an amateur. So, seriously.
Yes, absolutely. Yes.
By the way, I think he's going to take Bitcoin to the moon next, and Tesla would benefit tremendously because Tesla has bought a huge position of Bitcoin. I wouldn't be surprised if Elon has a strategy to rescue Tesla by making more money from Bitcoin trading than he has ever made in the car business, because frankly, he's never had a viable business plan in the car business. Right? And I think it could work. So, we're in just completely uncharted fiscal and monetary policy territory here. So how sure, are you ready to short it?
No. And what I was going to say, Erik, is it is a classic bubble, but you really only know a classic bubble when you've had the bull trap rally. So if we just assume for a minute, and I'm not assuming at this point that this is the top. So the bull trap rally would go something like this. You would break the neckline at 800. Okay. And then you would see a very sharp accelerative drop, a drop that could take you in a stock like Tesla, possibly, certainly down to 600, but possibly even as low as that sort of 470 line where you intersect with that 35 to 45 degree line, which is another key component of a classic bubble. You would then bounce, Erik, you'd come back up towards the neckline, but not ever exceeded it. And that's really the only point where you know that you've got the bubble, okay, that the top is in. Now, from here, I'll be honest with you, I don't necessarily disagree that this thing could go to 1200. I tweeted rather critically about some analyst who'd come out and was talking about their prowess in the potential prowess in the insurance industry, in the HVAC industry. And I said, these guys are just like bloody ambulance chasers, right? They're just momentum players. This has got nothing to do with fundamentals whatsoever. Not that the damn thing has had anything to do with fundamentals up until now. But he was calling for 1200. So is that possible? Absolutely. The only point that I've got, Erik, is Tesla went parabolic exactly the same point that Apple went parabolic when the Fed stopped expanding the balance sheet. So that disinflationary pulse, and you bought, to be honest, one of the ultimate growth names, okay, and Tesla was part of it. So this goes back to this interchange and these feedback loops between markets. What if now we are starting to see the inflation, and I think it's going to come through in spades. And what if that does stress bond markets? And what if those bond markets start to feed back into these super high PE stocks, right? Could this be the top in Tesla? And the answer is it could. I'll only know once we've completed that bull trap. But it is, to me, we're at this really, really pivotal point. And that's why I'm getting a little bit more nuanced on risk. And in a way, the last chart kind of sums it up. And it's the big debate, okay? Because we know we have loose fiscal policy. We have loose fiscal policy, the like of which the world has never seen. When I was running through some of the numbers that were the deficit projections as you look out over the next few years, two of my clients independently said, oh my God, these are numbers that a Banana Republic wouldn't be allowed to run. I mean, the numbers are just flabbergasting. So we definitely have loose fiscal. The big debate, though, is what is the Fed going to do about this? Okay. Are they going to accommodate it? In other words, essentially move to an MMT scenario where they basically underwrite that issuance, because the issuance numbers are off the charts, Erik. I mean, we're going to be running deficits that are more than twice total private sector savings in the US on an annual basis. So there's just no way that we ourselves can fund this. There's no way that foreigners are going to want to fund it, certainly at the level of bond yields as they stand at the moment. And maybe the Fed can just let the market rate for bond yields clear at an economic rate. But you tell me what that is. Is it 2.5? Is it 3? Is it 4? Right? I mean, let's just look at some of the forecasts of, what people like Goldman Sachs are penciling in for the end of this year. Right?
But hang on a second, Julian. Why in the world would the Fed, for the first time in years, allow the bond market to clear at a market rate when they can just buy up all the issuance with printed money?
So I'm absolutely with you. I'm just saying I don't think they can. All right. I don't think there's any way that they can, because then you're talking about loose fiscal, tight monetary. And you can see on this chart where I put the bars in, you can see the periods where the Fed we've had loose fiscal, but we've had tight monetary. So in other words, the Fed has let the bond market kind of clear at an economic rate, and they've been tightening to offset that fiscal impulse. And the dollar goes parabolic. And to your point, Erik, there is just no way, given the valuations of things like Apple and Tesla and all these other things, that we can allow that to happen. I mean, if you wanted the bond market to clear, then okay, well, you just accept 50% lower price on your Apple, which probably means the US equity markets drop 30%. Right? So I'm completely with you, sir, that that's what they have to do. My only concern is that is actually a deeply distasteful thing for them to do. Right? For them to run loose fiscal, loose monetary, which I think is the solution. In other words, they hold real yields down. Nominal yields can increase. They did in the late 60s, but real yields fell. Is crossing a Rubicon where essentially they abandon any pretense at independence. You can see from the debate that's going on internally that they're inching that way, but they haven't got to that point, right? I mean, if I use a silly little analogy, it's kind of that really crap Star Wars movie, I can't remember which one it was, where Darth Vader is still not Darth Vader, and he's umming and ahhing whether he's good and he's bad, and he's fighting these internal battles. And in the end, he goes off and he kills all the kids in the Jedi training school, and he turns bad. He embraces the dark side. Well, the Fed's got to do that. Right? They're going to have to, underwrite trillions of dollars worth of debt issuance, because we can't do it at a market economically clearing rate without crushing the recovery and the economy and the equity market, et cetera, et cetera. But they don't really want to go there. They still hope, I think, in their hearts of heart, that this is a normal world. And you and I know that that's a joke. So I do expect a bout of pain. I do expect them to be challenged before they come in and say, okay, your name's the Fed. We're locking in 10-year yields at, 1.5%, see you in 5 years' time. And that's another reason why just at this point, I'm turning a little bit more circumspect on risk. And it goes back to this sort of link between these markets. If I think inflation's coming through, and it's coming through in spades, and it's coming through extraordinarily quickly, Erik, and there's a challenge potentially coming to the bond market, as there was in late 2016 when bond yields popped very aggressively, having moved off the lows in the summer, they then shot up. Now is a time to just be a bit more circumspect. If I'm still running for my macro insiders portfolio, we're still pretty long risk. We haven't shorted anything. All we've done is tighten the stops and take some profits on some really illiquid things that I'd worry, could get really dislocated in some sort of, even if it's a short bout of risk off before the Fed goes, okay, fair cop, here you go, we're back in again. And that's kind of where I stand at the moment, because I just think we're at this handoff. Right? There's a lot priced into these markets. They've had a great run. We've had a great run. Most people have had a great run. But we're pushing the envelope now.
Julian, help me understand the upside risk to Treasury yields or downside risk to Treasury bonds, the same thing. I hear so many smart people. Our mutual friend Grant Williams was on recently on a podcast I was listening to this past weekend, and his partner Bill Fleckenstein says, watch out. You just watch out when the bond vigilantes come into town, and all of a sudden, it's like a horse ripping the stake out of the ground and running with it. I'm thinking, wait a minute. Just 2 sentences before that, I think it was Bill who commented that the Fed already owns a third of the Treasury issuance. What's to stop them from buying the next third? And the answer, of course, is at some point you get runaway inflation, it blows up the dollar, you lose reserve currency status, et cetera. But those are all big deal things that haven't happened yet. In the next 2 or 3 years, what's to stop the Fed from saying, bond vigilantes, we'll steamroll them. We'll just buy all the bonds we need to in order to get the yields where we want them, which is low?
Frankly, nothing, Erik. Nothing is to stop them to doing that, right? But as I said, I think that takes a mental step. I mean, I've talked about the late 60s a lot really since Trump got elected. It's been kind of the model, but a historical sort of analog that I've been following. And back then, we had a Fed president called Bill Martin, and he was actually the longest standing post-war, or I think the longest standing Fed president in history. And back then we had a fixed exchange rate, Bretton Woods, and kind of the job of the Fed, if you go and look at their meetings, which, oh my goodness, there were so many notes because it was every 2 weeks, right? But essentially you can go through and they're tracking things like gold flows and current account flows and capital account flows because they're worried by, how to hold the system together. So Johnson comes in and Johnson says, I'm going to launch this great society. And at the same time, we start fighting in the foothills of Vietnam War. And suddenly all these flows start to turn against the dollar. And yet the Fed is there to try and hold the system together. And they're faced with a dilemma. And the dilemma was, do we tighten rates and essentially push back against our fiscal masters, exert that independence, which we saw obviously someone like, Paul Volcker do a decade later, or do we accommodate government? And Bill Martin came out with a very famous saying where he said that the Fed is independent within government, but it is not independent of government. In other words, if his government is the manifested will of the people, then it's not for us to kind of fight against that. And so what they did was they accommodated it. And essentially, to help pay for Vietnam, we did stealth QE, which is why the monetary system fell apart in 72. And the dollar dropped 50% against the yen and the Deutschmark. And I think that's where we're going, Erik. I just think it was a pretty big step for Bill Martin to do. And I think it's going to be a pretty big step for a number of Fed officials to do. I think we're quite close to it with Yellen, in Treasury and Powell. But my sense, reading what these guys are seeing the pushback that we've had from, say, Kaplan and Bostic on rates, is there is a vestige of independence there that needs to be beaten out of them. And to do that almost certainly takes an element of pain. And that pain, I think, would be perfect if you've got a wobble in the bond market that causes the equity market to drop, 20%, the dollar to spike, and then Treasury read them a riot act. And then at that point, they say, we're just going to buy the whole lot. And they can, and I think they will. I don't think they've essentially got any choice. It's just a transition mechanism. It's the pathway that's less clear. But there are huge consequences for that, right? And they're summed up by this last chart. You run loose fiscal, loose monetary policy, you're going to annihilate the dollar.
Julian, your focus on the late 60s and inflation really gets my eye because, so many people have their own favorite indicators. So, some people like to look at the second derivative of growth, the rate of change and the rate of change and so forth. What I look at is the rate of change in the smartest people I talk to here on MacroVoices that normally I get just opposite views from lots of smart macro people. And recently, it's like all the smartest guys in the room are coming around to a secular inflation view. Some of them think it already started. Some of them think it's 2 years off. They all have a different spin on it. But it seems like whether it was Jim Bianco last week or a couple of weeks ago, Russell Napier, it seems like all of the smartest guys in the room are saying we are in the late 1960s in terms of a major secular inflation. And the thing that I think is fundamentally different is, and Paul Volcker said this himself before he died, he said, look, what I did in order to stop inflation in the 80s would never work today because we have a completely totally different situation in terms of indebtedness. There's no way you could possibly get away with the policy cure for inflation that worked then. So what I see here is that we're headed into what the Austrian economists call a crack-up boom, a government-led credit expansion that will probably, for several years to come, drive much higher asset prices, a booming economy, at least for the first few years, because you print enough money, it's got to go someplace. And eventually, it all leads to runaway inflation, which will be impossible to control because, raise rates is something you can't do without bankrupting the government. What you want to do is try to inflate away the real value of that debt. I think that's what they're going to do with a combination of financial repression, runaway inflation, negative real yields for a period of several years. Now, eventually, the piper always has to be paid. But you can, von Mises didn't call this a crack-up blip. He called it a crack-up boom because it can go on for years and years and years and create the appearance of prosperity when in reality it is like an irreversible atomic explosion of finance where eventually the whole thing blows up in your face. But that's years and years and years off.
Correct. And I would utterly concur with that, Erik. I mean, I think, I agree with everything you can't do a Paul Volcker, right, at this stage. I mean, not until you've eviscerated the real value of the debt. That doesn't take as long as you would think. I mean, in the 60s, we managed to get to 6% inflation with a fixed exchange rate and, pretty much control prices across everything, right? The Seven Sisters the big oil companies controlled the oil price, right? So one of the reasons why we ended up with the war in the Middle East is because we were trying to hold down oil prices. And then, OPEC came about because their income was being eviscerated in real terms. Gold prices were controlled. There were all these things that were controlled, and we still managed to get to 6. But it was another decade on from that Paul Volcker came into town, right? So, in 15 years, you can really, really, really eviscerate the value of the debt. So I don't even think we have to consider Paul Volcker at this stage. I've been on this inflation kick since 2016, since Trump came in. It's just plain to me that when you look at the picture, Erik, it's to embrace inflation, you need to be at the right point societally, not just in terms of the fiscal and monetary policy. Fiscal policy is a manifestation of where you are in society because you vote a government which is going to pursue certain things. But there are many, many traits that we have now societally that inflation is one of the few potential solving mechanisms, right? We have wealth disparities between old and young, right? Well, the way you deal with that is you run inflation hot, the wage increases go to the young, and the value of the assets held by the old fall in real terms. We have income inequalities, which are extreme. You had that during the 60s, right? We have all of these factors which are starting to combine, which societally are telling us we need change. Because otherwise, if you believe in something like the fourth turning, this is what I euphemistically refer to the period where you have heads on sticks, right? If you don't address these problems, you're going to have a society that's going to break down, and they're going to be chopping people's heads off, just like they did in France in the revolution, and sticking them on a bloody pole. So the easiest solution for government is to print money and to suppress yields. And I totally agree with that. It's just that transition point right here, right now. I'm a little nervous about, because I just don't think they've fully crossed over to the dark side. I think they will, but I just think it's going to take a bit of pain, or I'm concerned it is. So while I'm still running a broadly risk-on trade and portfolio, I'm just being a bit more circumspect about risk management, taking profits on things that are, extraordinarily illiquid, like corn, for example. We had a very profitable trade in, and tightening stops elsewhere. Because I agree with you, Erik, that's where we're going. But as I said, this inflation gig I've been on for 5 years. People thought I was nuts, right? We talked about it back in 2016.
Well, and I think when we talked about it then, you were clear in saying it's coming. It's not quite here yet. And perhaps it's still not quite here yet, but it's a heck of a lot closer than it was before.
Well, this is the point, right? We went to zero inflation in, the GFC, and now we're starting off from really at 1.5 to 2. And that's what kind of happens if you look at the charts of inflation. They become, it's like that accelerative oscillation you get. One of my quants picked this thing up, and you have a sine wave and it runs normally, and then you kind of hit it at the wrong point, and the oscillations just increase in amplitude every single time. And this time they're doing that, but they're just building slightly higher bases every single time. And that was actually the method that you saw in the late 60s and the 70s. You never quite got down to the prior lows. You kind of stopped at the prior highs. And then you built on it again, and you built on it again. In a way that policy error begets kind of policy error. Even if, to be really cynical, you want to call this a policy error, because I think it's partly a policy solution.
But I think the hesitations that you're expressing, as I understand them, around equity prices and so forth, are you saying, look, things have run awfully far, awfully fast. Maybe there's a pullback here. But you clearly see that this isn't over completely. There's more upside coming for equities eventually as this reflation or inflation kicks in. I want to talk a little bit more about the longer term, because it's hard to know what's going to happen in the next 6 months. But what I see here is eventually the U.S. government is going to print money and spend money, and a lot of both. And eventually we're going to get to a situation, I don't know how long it takes, where inflation does start to run away. And that's the point where they're going to let it run away, because by then they will have convinced themselves that it's not a threat, and they're going to average inflation instead of worrying about thresholds.
It's transitory, blah, blah, blah.
All that stuff. And also it is going to feel like everything is wonderful, because inflation for the first few years, every major inflation, has been interpreted by economists at the time as, hey, the economy is booming, everything is great. Well,
grease the wheels.
You get to a certain point and the inflation becomes detrimental. And in the past, when you didn't have an over-indebtedness problem, there was a very, very painful solution that Paul Volcker is famous for pioneering, but it was possible. It's not possible by Volcker's own description now. So the question that I really think about is, okay, how many years of false sense of security where it feels like everything is great do we have ahead of us before reality sets in and we realize, holy shit, this is already beyond the point of no return. We've got a runaway inflation problem and no way to control it, and this is going to lead to an inflationary depression, a loss of reserve status for the dollar, and all the bad stuff. Is it a year off? Is it 10 years off? I mean, what do you think?
I think it happens much quicker. I think the world just moves quicker these days, Erik. And to go back to that 60s analogy, as I said, you go into the late 60s with many mechanisms that prevented rapid movement, controlled gold prices, right? A controlled exchange rate mechanism, controlled oil prices, national wage bargaining in parts of Europe, right? I mean, many things that were designed to quash some of those accelerative oscillations that I talked about. It's not the case anymore, right? We have freely tradable markets, right? And we've just seen how far quick Bitcoin can go, which is something that, Raul, who he and I, collaborate on the Macro Insider portfolio, has been all over. So, God forbid what happens if this thing really starts to move quickly. I mean, does this go to 100,000? easily do it, right? So I think the answer is much quicker than we think. I mean, I have some dollar models, which, and I think this is, for a US perspective, is kind of the Achilles heel. I have some dollar models that suggest that by early 2023, so 2 years from now, the dollar's lost another 35 to 40% of its value. That's going to create problems, right? That's going to create problems, particularly in a world where the holders of our reserves, unlike the 60s and 70s, are not our friends, right? I mean, it used to be that Japan, Korea, and Germany held our reserves and we provided them with strategic defense. Now our reserves are held by the likes of China, and not easy to say that they're our friends, certainly not the CCP.
Julian, let's talk about how we know when we're at the point where it starts to turn from good to bad. When I asked Russell Napier the same question, he said, watch observed and reported CPI inflation. Once it's past 4%, that's where you start to worry about it being negative for the economy and the stock market as opposed to positive. Would you agree with that number? But more importantly, is that the right metric to be watching to tell you when we turn from good to bad?
I mean, I can see in some of my models, I mean, I was looking through some of the PMI reports and some of the details of the PMI reports the other day, and some of the Q&A and observations, particularly for some of the market reports who do really very good work. And there was an observation in the US manufacturing PMI about company prices increasing at the highest rate and since July of 2008. Do you want to take a guess where CPI was in July of 2008? No?
Nope. You got me.
5.6. 5.6%. So if Russell's level, I'm not disputing it, is 4, we can be there much, much quicker than people think. I'm not really sure, as I said, that it's the metric, because the metric, as I said, is more, it's a process that gets us there. So as I said, to really get us through the higher inflation environment, first we've got to have the Fed acquiesce and admit that they're not going to fight it. Okay, and then they're going to have to hold down bond yields so the bond market can't fight it. And then, as I said, to me, the thing that's going to cause the most pain, the thing that becomes an issue, is not bond yields because they're pegged. It's not equities because they're ripping because your real yields are extraordinarily low. May not be US equities that are ripping the most. I think there are other things that can outperform, as I said, particularly in an environment where US equities are already grossly overvalued. It's the dollar. To me, the dollar is the potential Achilles heel for all the reasons that you've talked about. And I'm not, please, don't put me in the, we're going to replace the dollar as the reserve currency. The Chinese are going to replace the dollar as the reserve currency. Well, they may in 10 years' time, but they ain't going to do it by 2025. And I think that crisis can occur before 2025. But it doesn't mean the dollar can't fall in value and fall precipitously in value, because it's done that in the past, right? I mean, it fell in the 70s from 72 to sort of 79. It basically fell 50% against the other major currencies. Didn't mark its demise as the reserve currency, it just fell 50%. But it would cause huge problems here, Erik, right? I mean, it would just cause huge problems. I mean, inflation would be rampant. So to me, the metric I'm looking at is more the process that gets us to the point where the dollar can start to slide. And that is when you get problems.
Well, Julian, I can't thank you enough for a terrific interview, but as we close, please tell our listeners a little bit more about what you do at Macro Intelligence 2 Partners, MI2, not to be confused with James Bond's employer, MI5.
So, yes, of course, being a Brit and a little boy, I had to use that, I had to do that play, because we all want to be James Bond. So MI2 is our institutional product, goes off to hedge fund, real money managers, family offices, that sort of thing. And anyone who's interested in that can contact us at support@mi2partners.com. Then we have a joint venture, as I mentioned, with Raoul Powell, which goes via Real Vision. That's called Macro Insiders. You can find that on the Real Vision website. And it's a lot cheaper. It's a slightly different product, same to the thing. But we do really quite actively help you manage your money and run risk and do stuff like that, which institutional investors really don't need. And then thirdly, if you just want to follow me on at Julian MI2 on Twitter. And and then you can see what I'm sort of pontificating on those various things. I'm also on LinkedIn, and you can find me there as well.
Well, thanks so much for another terrific interview. Patrick Ceresna and I will be back right after this message from our sponsor. Did you know that there's a regulator-approved diamond commodity? Every diamond standard coin contains the same geological content of diamonds, so the coins have the same value. Because they're fungible, you trade diamond standard coins quickly and easily, like gold, at a market price. Inside each coin, a wireless computer chip stores a blockchain token. While a custodian holds your coin, you can trade the token instantly. The value is real. It's a blockchain-native physical commodity. For the first time, diamonds are liquid and mark-to-market daily, enabling institutions to build positions and to create securities. Futures are coming to CME Globex, and an ETF is pending SEC approval on the New York Stock Exchange. This $1.2 trillion hard asset is uncorrelated to stocks, bonds, and other commodities. Investors own at least 15% of precious metals, but no diamonds, leading to a secular position-building opportunity. Find out more or place an order at diamondstandard.co.
Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, it was really great to have Julian back on the show. It really resonated with me when he was talking about the impact of higher interest rates and what it could do to some of those growth stocks. I certainly think it's one of the things we're going to have to watch. But I really wanted to circle back and ask you about this. Was that ad right that I just heard was claiming that there are now diamonds and chips in a physical coin? Like, what was this all about?
Patrick, it's funny that you noticed that, because when I got that ad copy from Diamond Standard, I questioned it too. Let me give you the backstory here. I originally thought that this company, Diamond Standard, was doing a fairly obvious thing that other people have done for gold, which is to, keep their diamonds in a vault and have a blockchain coin, a token, which is not a physical coin, but a coin that exists on the internet like a Bitcoin. And that would represent fractional ownership of some diamonds that they're vaulting and keeping custody of. Fairly obvious business model. That's what I thought they did. So when I get this ad copy that talks about a physical coin with a microchip in it and diamonds in it, I'm like, okay, how do I let this guy, Cormac Kinney, the principal at Diamond Standard, save face? Because obviously, his administrative assistant is confused. And I sent him a nice email saying, I think they're confused. And he sent me back. He says, no, Erik, she's not confused. She got it right. You're the one who doesn't get it. It's actually a physical coin, a physical coin-shaped thing that contains diamonds. So the diamonds are not in somebody else's vault. They're physically in the coin. But also in the coin is a wireless chip that contains a blockchain token that says who legally owns the diamonds that are in that coin. So the idea is, if you have it with a custodian, you can transact it on a blockchain electronically, and you can instantly transfer title and ownership to somebody else. But also, if you had physical custody of these coins that have diamonds inside of them, then if somebody stole them from you, as long as they're still in that format inside of the coin with the chip that has the blockchain token, you'd be able to, to detect that and find out the guy that's trying to sell these coins on the black market doesn't really own them because they're registered to somebody else. It's a brilliant idea, and it wasn't until I thought that ad was wrong, got a hold of Cormac, and he explained to me, no, it really is a physical coin that contains both a blockchain token in a chip and physical diamonds. So obviously, I would want to know what grade of physical diamonds are they, and what's the wholesale value of those diamonds relative to the cost of these tokens. But it's, what I think is really interesting about this, Patrick, is it's one more example of decentralized finance really getting innovative and doing creative things that are different than what we're used to the point where I even questioned whether the ad was real when I read it myself. So I think it's a sign of the times, and I think we're going to see a lot more decentralized finance innovations in coming months and years. In any event, Patrick, let's move on to this week's Postgame chart book, which is titled Rolling Bubbles. So as we roll into the Rolling Bubbles chart deck, page 2 shows the FANG Plus Index futures. Wow, looks like secular inflation to me.
Well, it's interesting because that was the one Julian Brigden was talking about as we go into this whole idea of how much impact, let's say, lower yields have had and have driven all of this. But it's interesting because our good friend Kevin Muir, all the way back in 2014 and again in 2017, was writing a whole series of articles talking about this idea of rolling bubbles, and when inflation comes, that it would create a sequence of bubbles that would roll one into another. And I just wanted to take a tour of what's been hot and how far they've gone, and really put context into this and really reflect on how these things could really play out. Nonetheless, it all really started with the FANGs, and it was the place where so much performance existed even prior to the post-coronavirus period. But it was really since March that we saw this extraordinary several 100% run in the FANGs Plus index. It's FANGs Plus because it also includes stocks like Tesla and Nvidia and other ones like that. But really, this index has just been on fire. It didn't even stop there. A similar time, that social media basket after the coronavirus bottom back in March of 2020 also went on a run of several 100%, and really seems to now almost be reaching a parabolic state on the upside as it's just turning higher. And so it's amazing to see that where all of this money is channeling and focusing all of this energy to the upside, right? And moving on to page 4, where I put on ARK. And really, the reason I chose Cathie Wood's ARK ETF is because the bubble really then rolled into the EV space. And while I didn't want to go and cherry pick individual stocks, including Tesla in this basket, because ARK owns a very large exposure to that whole EV story, it really kind of shows how that money flow came right into this kind of basket and really drove this big accelerated move that has just has not quit on the upside, right?
Well, it really is an amazing story, and I think ARK is a particularly good place to look because Cathie Wood, to my mind, really personally epitomizes this new mentality on Wall Street, which clearly is working. And I certainly don't mean to be down on Cathie. She's making lots of money for her clients, and congratulations, Cathie, if you're listening. Your performance has been phenomenal. But if you listen to what she says, if you watch her in interviews, she kind of rolls her eyes and says, "Oh boy, these old school guys that think profits and revenue and that stuff are important don't get it. We're in a new paradigm. It's a new investment paradigm. A company like Tesla is going to be delivering these electric vehicles as a service, and it's a new paradigm." And the fact that it's really clear to any business person who looks at it that they're not going to make money making these electric cars, Cathie is dismissive of that and says it's not important. Well, as much as old school guys like myself might be inclined to roll our eyes and think, boy, Cathie, you don't think profits and revenues are important? Come on. Well, look at her performance. She is very much in tune with this storytelling paradigm that is allowing a story like Tesla that has never shown a profit and shows, as far as I can see, no sign of ever showing a profit, to continue to be one of the most profitable investments in the stock market. So, folks who think like Cathie, which, she doesn't think like I do, that's for sure, but it's working. It's working for them. They're making lots of money at it.
Well, Erik, I'll push back on you a little bit on that because, if you think back to even 1999, 2000, during the rise, everyone looked like a rock star that was pushing the internet stocks on the upside. I mean, I don't think we've really seen how the whole story plays out. I mean, just identifying it during the rise, I just think that we just have to see in the end how it goes through the downturn cycle to really already be patting people on the back. But one way or another, you're right. She has truly caught the right wave, and there's no denying that. What's interesting on page 5 is I wanted to...
Well, hang on, because I want to make sure that we're clear. I couldn't agree with you more, Patrick. Where she is we're in 1999, and just like there were people in internet stocks then saying, look, it's a new paradigm. Profits and revenues and all that stuff are not important. It's a new paradigm because the internet's going to change the world, and you want to be part of the story and stop worrying about profits and all that stuff. Cathie Wood is the current day equivalent of that. Now, so far, she is on an incredible wave, and she's turned in some incredible performance. Is it all going to blow up in her face just like it did in 2000 for the internet folks? I think it will, but hey, I could be wrong.
Right. So what I wanted to, though, show on page 5 is how that EV push has really spilled into the entire global auto index. And so the CARS ETF, which owns all the major auto companies around the world, has also just caught on fire. And largely because obviously many of these companies are also moving into that EV space. And also this index now has a very large weighting into Tesla. But certainly, I mean, up a couple 100% off the March lows, just being in the auto basket has had the same type of impact.
Absolutely. And again, I think this is a sign of this shift toward secular inflation. Hard goods like automobiles are going to be in demand. We are going to see a change toward government emphasis on eliminating fossil fuel burning vehicles and moving to electric vehicles. That's going to create new demand. And it's going to sell lots and lots of electric cars in coming years. So I don't think it's any surprise that you're seeing this kind of price action across the board. I think automotive is going to be a very, very busy place in coming years.
So what I wanted to now go on to page 6, where we want to talk about the new entrants to the bubble, the ones that are just joining the party at the tail end. Obviously, the most recent one was the idea of squeezing shorts, and this idea that nailing the most shorted stocks is where the money is. And it's interesting because I just chose GameStop here because I don't have an index to really touch on there. But it seems like even though GameStop has fizzled out, this game has just started.
Oh, come on. It's going to 600. I read it on Wall Street.
But what we're seeing is that there's now a very big attention to the most shorted stocks, and there continues to be buzz about what's the next GameStop. And it really now is something that has captured the imagination of speculators to be able to continue to find these types of stocks and securities that have this tailwind behind them on cornering shorts that have gotten a little too comfortable in their positions, right? Anyway, Erik, so I wanted to touch on the Bitcoin story, but not so much the Bitcoin itself, but now the stocks that are buying Bitcoin. And particularly, obviously, there's Riot and a few of these other ones, but I really wanted to touch on MicroStrategy, that MSTR. And what's interesting is that this stock and the CEO came in with this idea that they're embracing this new Bitcoin technology, and they started to turn around and accumulate very large amount of Bitcoins in this publicly traded company. And a lot of the players out there that couldn't access the Bitcoin markets suddenly saw stocks like MSTR as opportunities to get exposure to crypto without actually having to buy the coins directly. And what's amazing is that now we're seeing a bubble within a bubble, because whether you think Bitcoin is a bubble, what we're now seeing is these stocks that are buying Bitcoin have actually just gone completely parabolic. On this chart on page 7, I have Bitcoin with the white line, and that MicroStrategy in orange. We have now seen a complete decoupling as people are now in this bubble phase outright chasing these stocks. And to kind of really show how crazy that has gotten, on page 8, what I have is a chart of the market cap of MSTR over the net asset value of the Bitcoin it owns. And so right now you are paying a ridiculous premium over net asset value of the coins to be participating in this through a stock like MSTR. And so it's amazing to see how these different bubbles just keep rolling and finding new places to create these huge excesses on the upside.
Well, Patrick, just to clarify, I think Bitcoin is a bubble, but I think it's a bubble that maybe is just beginning to get blown. It might have a whole lot bigger to go. And certainly, as I said in the market wrap, with Elon Musk now helping to drive the story higher, nobody can drive a story like Elon. How much farther can these things go, Patrick? I have absolutely no idea. I do admit that there have been times when I look at some of these charts like this in terms of the premium being paid here, and I think to myself, what are these guys smoking that they're paying this? Well, let's move on to page 9. I think they're also buying the pot stocks, too. Whatever they're smoking, they're investing in that, too.
Well, that's the rolling bubble just then moved on to these cannabis stocks. And what's interesting is obviously one of the tailwinds was the blue sweep in the political front that really kind of gave this some real momentum behind it. But we're suddenly seeing several 100% on the upside of anything to do with cannabis. And so the question really is that where is the next crazy spot that this is going? This rolling bubbles is just
I heard Cheech and Chong are going to launch a hedge fund. No,
probably, and so it's probably going to be a SPAC though, but anyway, so it's really interesting to see that it's almost like what we're seeing is that the internet has created this congregation where these speculators can now pool and on an instant notice get what is the next hot thing, and everyone trips over themselves rapidly to get a piece of the action as something goes. I don't think this is over in terms of rolling bubble. I don't know whether the existing bubbles on a lot of these will continue, but it almost seems like they're going to find something new to take to the moon and just go to the next one. And so it'll be really interesting to see where we can spot where the next really crazy breakout occurs. But one thing that I do want to highlight, going to page 10, is something we had on a chart a month ago where I looked back to 1999 to 1998 to 2000 period, kind of showed how the NASDAQ created this monstrous outperformance relative to the S&P and the Russell. And really what I think I wanted to take away with this is that it really shows what's happening, right? So I'm going to show in a second the chart of the S&P 500, and it's been trending higher, and even the Russell's been participating. But really, just like those internet boom tech stocks ran in 1999, it really decoupled from the broad market, right? Like when you actually are dealing with companies that have earnings and real fundamentals, no one gives a shit about those stocks anymore, and they're simply not participating. And if you own a basket of consumer staple stocks or communication stocks, it's just not happening. And you have to be almost chasing the momentum of where the herd is concentrating all their attention to get a piece of the action. And that really is something that exemplifies this market, and it really echoes and mirrors and that analog from that 1999 period, right?
Absolutely. Well, how far into the 1999-2000 story are we, Patrick? Because there's a big difference between 1999 and 2000 in terms of how things turned out.
Right. I mean, well, back then I was just showing how that index went 300% back then, and we're only up a couple 100% off the March low. So there is no denying that these bubbles can get even bigger. It's very premature to already be saying that it's over, but it'll be really interesting to see whether we have rotation in the bubbles. Like maybe some of these bubbles, like the EV bubble, may already start correcting. You know, it really does feel like Tesla is bumping its head. I'm not forecasting that, but I'm just saying, what if we see a scenario where like the EV space starts to correct, but the market finds a new place to pour into a bubble, and it's just a rotation driving up different parts of the marketplace in this concentrated way. Anyway, what I wanted to touch on page 11 with the S&P 500 is just that slow crawl that the broad market has. There is no big parabolic rises or, these big, huge percentage gains. The S&P is sort of just a silent participant in and slight benefactor of the fact that everyone is just no reason to sell this market at this moment and just crawling higher, always banging its head on the next kind of gamma overhead resistance level, call walls, and other things. But it really is a scenario where an index investor who owns a participation of the S&P 500 has almost been left behind when you see how some of these other little pockets within the markets are running. And it really kind of shows just how the froth of this market is playing out. I personally don't think it ends well. I think you agree with that, but it's just really, I guess the big question is how long can it last and how far can it go? Because there is no evidence that it's ending today or tomorrow, right?
Well, Patrick, I think the big question is what can you do to trade this? Because I think we agree it's going higher first before it goes a whole lot lower. But guess what? It might go a whole lot higher before it goes a whole lot lower. So what do you do in order to not, I certainly wouldn't dare to short the market here. On the other hand, I don't really want to be exposed to the long side because I think at some point there is a big reversal. Maybe we should do a whole post-game segment at some point going back and reviewing some of the strategies like the calendared straddle that you use at Big Picture Trading and what the ways are that you can play this. Because I think that we are probably in 1998 or 1999. Market's going to continue to melt up much, much, much higher until everything blows up and it all goes down suddenly and takes everybody by surprise. I have no idea when that's going to be, and I don't dare trade either side of this directionally unless it's in a very carefully hedged way. So we should probably look at strategies like that in coming weeks.
Oh, for sure. We can circle to that. What I do want to leave this post-game with is another interesting chart that was brought to my attention by Kevin. It's the micro index. And what this index is it takes the Russell 2000 and only looks at the bottom 1,000 stocks within there, plus the 1,000 stocks that are waiting to come into that index. So it's really looking at that smaller component of the market. And what's amazing is that this entire space has also been running. I mean, we have seen almost 100% rise in those micro stocks. And so it's, when we hear a lot of those people talk about the fact that indexing is taking all the money, clearly there are spaces and pockets within this market that are getting a lot of momentum behind them at the tail end. And that continues to show just the froth within the markets.
You mentioned our good friend Kevin Muir. I just want to let our listeners know, in your Research Roundup email, you'll find a link to an article by Kevin explaining inflation break-evens and how they work. It's a measure of inflation expectations in the marketplace. If you're not already familiar with the theory of inflation break-evens, I highly recommend that article because it's very much going to be timely and relevant. Meanwhile, you can get a free trial membership to Patrick's service, Big Picture Trading, where he does chart books like this almost every day of the week, 4 days a week at bigpicturetrading.com. There's more information on page 13. We're going to have to leave it there for this week's show. This episode is brought to you by Abax Technologies, pioneering the design of smarter markets that better meet the needs of both market participants and society as a whole. And by Diamond Standard, the world's first regulator-approved diamond commodity, a new hard asset whose time has come. Visit diamondstandard.co. Patrick, what can they expect to find in this week's Research Roundup?
This week, you're going to find the transcript for today's interview, as well as a link to Julian Brigden's slide deck and a chart book we just discussed in the postgame. There's also a link to a Goldman Sachs interview with Stanley Druckenmiller and a link to an article discussing Charlie McElligot's next big thing to watch for. So you'll find this and so much more in this week's Research Roundup. So that does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com or tag it with the MVRR hashtag on Twitter, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend, that's Erik spelled with a K, and myself at Patrick Ceresna. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.